Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote comparing and contrasting level versus seasonal production decision-making process. We will have a situation where we have seasonal production, thinking about moving to level production, and think about the factors that would be involved in that decision-making process. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you'd like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 726 Level versus Seasonal Production Decision in the Practice Problems tab. Closing this back out, we're going to have our information up top. We'll use that to work through the practice problem down below. The general scenario is that we're imagining a situation where we have seasonal sales, so the sales are going to be higher in some months than in other months. They're not going to be even throughout the year, and then we have an option as to whether we want to make our production lineup to be even throughout the entire year, at which point if we do that, we're going to have some areas where we have higher production over what the sales will be, and we'll have some inventory buildup, and then we'll be able to sell more than we produce because of that inventory buildup in the higher months, or we can try to ramp up production in those months that we think are going to be high levels of sales, and then increase the production right before that point in time. Now remember, there's pros and cons to both of those decision-making processes that we want to be considering as to whether we want to be going from one decision or the other. We're going to imagine a situation where we have seasonal production, meaning we're ramping up our production process for those points in times where the sales will be higher, and then we're lessening our production process for those points in time in the year where sales will be less. Now, the pros and cons for this kind of process, you can imagine this situation. You could say, well, there's a cost to us producing the inventory, and some of that cost is going to be labor is going to be involved. We've got machinery involved, and then we also have the holding costs of us holding on to the inventory. We may also have costs of us financing the production process, because if we're not making the sales relatively soon, we might be needing to finance the production process with some kind of loan that we're going to be taking out in order to go through the production process. So there's going to be costs related to the inventory. So you might then lean towards the idea that we should ramp up the production at the point in time right before the big sales are going to happen. So for example, if we have big sales like at the end of the year in December or something like that, if it was a retail store or something, we might ramp up the production right before we have that big month that's going to happen. And that way we're going to reduce some of these costs, such as possibly financing costs, such as costs related to the holding on to the inventory and whatnot that are going to happen right before that point in time. However, on the other side of things, we could think of, well, if we had an even production throughout the year, if we didn't do this fluctuation thing, it would make things a lot more efficient, because we would be just doing we could standardize the process, which would make things easier. So if there was intensive labor in the production process for us to be making whatever it is we're making, it would be a lot easier on the labor if we didn't have to have a lot more hourly labor in some months and then reduce the hourly labor in other months. If we could just have a set labor force that can be working relatively evenly throughout the year, then that would be a lot easier for us to be setting up the labor. We would have less overtime that we would need during these high months. We would have less wear and tear on machinery right before these high months. We might have less risk due to the cranking up of the production during these high months, and we'd be more likely to be able to meet the needs of inventory needs if there's some kind of spike other than the normal seasonal spike that we would have throughout the year, because we would have built up inventory in order to cover those spikes and be able to make those sales. So that's kind of like the trade-off that we would have. So if we're going from seasonal production, we would have to think about, okay, what if I went to level production? Would it be worthwhile for us to do so? We'd have to think about the pros and cons, measure it basically in dollars. So we're just going to assume here that the after-tax costs would decrease due to the added efficiency. So we're going to say if we were to go from seasonal production, where we're ramping up production right before those peaks, we would be more efficient. We would be able to use our wages more efficiently and our machine hours more efficiently. We would be able to standardize the production as we make the same amount of units each month, and we could get better and better at that because we're doing the same thing over and over again. We believe that efficiency would have to put a dollar amount to that of the 41,000. And then if we say the inventory is going to increase, we could say, well, there's an increase in inventory. That's going to be our inventory buildup, the asset buildup. And we're going to say if that's 460,000 in terms of the asset buildup, then we might have a financing cost with regards to the asset buildup. Because if the assets build up in inventory and we're financing that asset buildup with basically debt because we're not selling that inventory during possibly the middle of the year or the lull in the year, the low part in the year, we're holding on to it until we get to that peak time in sales, then we might have a financing cost. And if the financing cost is, let's say, 10%, 10.5%, then would it make sense to make the change? So if we think about that, we'd have to say, all right, well, if there's a decrease in cost due to efficiency of the 41,000, we'd have to compare that to basically the financing cost that would have to increase in order for us to be switching to that model, that production model here. So we'd say, all right, that's going to be the 460,000 that we're basically financing times 0.105. That's going to give us the 48.3. And then if we subtract those two out, we'd say, well, there's a loss if we made to that change. So we would probably, according to this analysis, stick with the seasonal production. So these are pretty simplified, the two kind of things that we would have to be kind of thinking about when you're thinking about these, whether or not to have a seasonal production or to have a fixed production. Now you might say, hey, well, what if this financing cost changed? I mean, what rate could this be then in order for these two options to be the same? Because you might prefer, the standard production process. It would be easier on on the wear and tear of things, on the mindset to do a standard production process, you would think, because then again you can kind of standardize your process. So you might say, well, where could I get the financing cost to be? Maybe to make it so it would be an even switch to be going between these two models. And you could say, all right, well, let's try to find that equilibrium interest rate for the financing. So if we say there's a decrease of the 41,000, then we're going to say, all right, then we need the inventory, and we say there's an increase in the inventory of the 460. That means the equilibrium interest rate would be about 8.91, or in other words, it would be the 41,000 divided by the 460,000, moving the decimal two places over, about 8.91%. So if we got the rate to be about 8.91%, then the switch looks like it would be even between the two according to the numbers that we have here, right? We'd have the 41,000 for the decrease in the cost, and then we're going to say that if we take this interest rate times the 460,000 for the financing, that would give us the 41,000, and we would be even under the two approaches in that case.